Started. It is noon. Like to welcome everybody to our February 2024 market update. I am Brad Engle, the Director of Research, Trading, and Portfolio Analytics here at GHP Investment Advisors. Joining me as usual is Christian Lewton, our Chief Investment Analyst. Hold on, Christian's muted. We'll jump over our disclaimer page. For those of you, we'll leave it up for a second, but for those of you that aren't familiar with us, we are a fee-only fiduciary registered investment advisor. We manage around $2.5 billion in assets. We are based out of Denver, Colorado. Here at GHPIA, we work with clients on retirement planning, education planning, insurance review, income tax planning, estate planning, as well as building custom investment portfolios that meet client-specific needs. From a housekeeping standpoint, quickly, we're going to keep the presentation to around 30 minutes. We will take questions at the end of the presentation, but you can submit a question at any given time. There is an icon at the bottom of the screen. If you might have to hover to see it, but it should have a Q&A. Feel free to put the question in there and we will sort through them at the end. If your question does not get answered, or if you have more questions or want more in-depth detail on something, we will provide our contact information at the end. So feel free to reach out to us. Christian and I love to have these kind of conversations. But for now, I'll hand it over to Christian to get us started.
Yep. Thanks, Brad. And thank you everyone for joining us today. So to jump in here, we're going to start today. We're going to dive into what we are currently seeing in the equity markets. Obviously, the euphoria, surrounding a lot of these big tech stocks comes to mind. But we're also going to touch on some other areas of the market where we do still see value. Next, we're going to give a run through on some recent trends we see in the labor market, as well as some inflation data. And then we're going to look at what the data is telling us in regard to the state of the consumer. And then finally, we are going to wrap up with some geopolitical thoughts. So to jump in here. So starting off with big tech, or the so-called Magnificent Seven, which is, of course, Apple, Microsoft, Amazon, Nvidia, Tesla, and Meta. So these companies, obviously, they do continue to dominate many of the headlines lately. And honestly, it is for good reason, being that a lot of these stocks have driven the majority of the return in the S&P 500, over the last year or so. So the hype around these companies is driven mainly by this generative AI boom, or artificial intelligence boom. For example, we've seen Microsoft and their partnership with ChatGPT, which I'm sure many are now familiar with. And then you've seen Google follow suit and released a similar product called Gemini. And then we've seen recent announcements from Amazon regarding Rufus, which basically just uses AI to help customers shop on their platform. And then you also have companies like Nvidia, which is providing the cutting edge hardware, which is basically just allowing many of these companies to create a lot of these Gen AI applications. So the question really is, are we witnessing some sort of bubble forming in the artificial intelligence space? I think if you just looked at 2023 returns for a lot of these companies, which I think on average, these companies are up around 110%, you might say these companies have to be overvalued and we are looking at a bubble. However, when you actually do look under the hood and you look at some of the company profits and the cash flow, it does start to tell a different story. So starting with the chart on the left here, you can see that the combined net income of these Magnificent Seven stocks over the past year was $372 billion. And this is more than double what these companies combined generated just prior to the pandemic. And then if you actually look at these companies individually, every company's seen their net income grow by over 100%. Since prior to the pandemic. That is except for Apple, and Apple is still up 83%. And then when we look at valuations in the chart on the right here, and I will note we have seen some multiple expansion specifically over the past year in a lot of these companies. You can kind of still see that the current forward valuations look very reasonable, and many are actually still trading below our benchmark. And just for comparison purposes, Brad is going to show us what we saw during the dot-com bubble.
Thanks, Christian. Yeah, so most of you are familiar when we say bubble, probably with either the global financial crisis or the tech bubble that happened in the late 1990s, early 2000s. And so we decided to kind of go back and look at history to say, what did it look like then compared to what it looked like now? And so if you look at this chart on the left, we specifically tagged Microsoft only because they still exist even after the dot-com bubble. Well, when you look at Microsoft back in the early 90s on the chart on the left in the gold line, you see it spike dramatically when we were going through that bubble situation. And it got all the way to 80 times earnings. Now, when we talk about price to earnings ratio, we're talking about the price of the stock divided by their earnings per share, which in this scenario and in the dot-com bubble, prices jumped in large numbers over time. There were about 70 dot-com stocks that were involved in it, but there was massive amounts of inflation in price. Earnings did not keep pace with that. And because earnings did not keep pace, you see that valuations jumped dramatically. Once that bubble burst, you can see that valuations came tumbling back down where the price fell back in line with the kind of a true earnings number, and it became cheaper, if you will. So then if you look at the stock on the chart on the right with the blue line, you can see that during that time, Microsoft's stock price jumped dramatically during that bubble. There was euphoria going on. Everybody wanted in on the tech, the new technology. Lots of companies within that time frame didn't have positive earnings. Some didn't have positive revenue. Microsoft was different, but they got caught up in that bubble. So if you were to purchase Microsoft during that tech bubble period, you can see once that bubble burst, the stock price fell dramatically. And for a company like Microsoft that we all use today, I mean, we're using a Microsoft product right now for this presentation, it would have taken almost 17 years to recoup your losses after that bubble burst. Christian, if you do me a favor, jump back to the chart before. So with that being said, and Christian's point, we are not seeing a bubble right now, or we don't feel like we're seeing a bubble, but we're seeing something unique going on. And to be honest, if we were seeing a bubble and our benchmarking and our investment philosophy would point to us in certain directions, but we actually still hold quite a few of these Magnificent Seven, and we are actively buying in our portfolios. We're currently buying Apple, Microsoft, Google, and Meta. The question that we're kind of trying to wrap our head around is NVIDIA. And most of you, as you know, right now, NVIDIA is all over the news. It's everything you hear. It's the growth. It's the new GPU chip for advanced AI, and it's this amazing new development. Well, the problem with us for NVIDIA is that the growth expectations on the stock are so high that it's hard to keep pace to see if they could keep pace with that growth. For example, over the last 12 months, NVIDIA grew earnings by 385%. That's an amazing number. Going forward over the next 12 months, they're projected to grow earnings by 110%. We think NVIDIA is a great company. The problem for us is looking at NVIDIA, if they do not reach that 110% growth at their current valuation, we expect to see massive amounts of volatility in the stock price. Now, it doesn't mean that the company is a bad company if it grows at 100% earnings, but the market is projecting that 110. And even if they grow by 80%, that's an amazing number. Again, the volatility in the stock price is what scares us. So looking back as early as 2022, NVIDIA fell 50% that year. Most people don't even remember that. In 2018, they fell 31%. So you can see there is somewhat of a FOMO moment is how we feel it is right now. We're getting more questions. More people want to get involved in NVIDIA. And the question is it too late? For us, the high growth and the high expectations is enough to keep us on the sideline because of kind of what we displayed in that Microsoft scenario. Those growth expectations could cause volatility in this stock price.
Yeah, I'll just add something here, and to Brad's point about the companies that we are currently buying, like the Apple, Microsoft, Google, and Meta. So I just want to point out that the monetization process of these AI applications that these companies are currently working on, it's still in the very early innings. And we continue to see strength in their actual base business model, not just the AI side. And then their expected growth rates, I mean, we're looking at closer to 10 to 15% in most cases, obviously compared to the NVIDIA, which is, I think Brad just mentioned, 110%. So we feel those growth rates are still very reasonable, and this is kind of why we still do find a lot of these companies attractive. Okay, switching over to small caps here. So if you recall from our last market update in August, we talked about the valuation discount we saw in small caps compared to large caps. Well, it's funny enough, we actually have the exact same chart today as we did back in August. And despite the 22% rally that we did see in the final months of 2023 in small caps, you can see here the small cap S&P 600 is currently trading at just 14 times next year's earnings compared to over 20 times for the S&P 500. So we do agree that some of this discount is justified given the higher interest rate environment we are in. Given small caps typically carry a higher percentage of variable rate debt, which can eat into profits. However, we do continue to feel there is opportunity given this significant spread. And I would honestly say this is especially true given our approach to stock selection, being that we invest in companies that have stable margins and cash flow, as well as ample ability to service the debt.
And I'd like to point out to Christian's previous slide, we use the S&P 600 kind of as a benchmark or an index when it comes to small cap stocks. Some of you might know the Russell 2000, which is the 2,000 smallest stocks in the domestic market or stock market. We shy away from the Russell 2000 because we've come to find that currently about 41% of the companies in that index are unprofitable. They have negative earnings. That's up from around 18% in 1998. So you could see somewhat of a dramatic jump. We typically like to go look at the S&P 600 small cap index and compare it to our individual stock selection because you have to have positive earnings to get into that index. So we feel it better represents what we're looking at. So taking that into consideration when looking at these charts here, small cap stocks typically have higher debt costs, if you will. There's higher interest rate on their debt because they are smaller compared to large cap stocks, which getting lending is easier and typically cheaper. So some of the criteria that we look at when we're looking at small cap stocks for our portfolio are on the screen here. There are many more we look at, but these are just the ones we're going to touch on today. The first one on the left is interest coverage. How easily can a company cover their interest expenses on their balance sheet? And you can see here that the S&P 600 index shows that companies are just over a 3 when it comes to covering interest coverage or their interest coverage. Our small cap buy list and all the stocks put together, we're on an average is over a 6. So we look for companies that can more easily cover their interest expense. Second, in the middle chart, we look at a company's debt to assets. Obviously, if you carry too much debt, it can really hurt your growth in the future and drag down your financials. And you can see here that the S&P 600 index, or kind of a benchmark that we look at, is just above a 28%. We are typically right around 26% on our current buy list, so we feel very comfortable with that. When you look at the chart on the right, our profit stability, we use that a lot around here when we're looking at names, and that's kind of a proprietary formula to us internally that we created. And what it looks for is it looks at the stability of a company's operating margins over a period of time. So for example, we use a 5-year and a 10-year here in this chart. We do other variations of years, but if we were to look at the 10-year profit stability, what that does in our eyes is it takes 10 years of quarterly operating margins and it divides them by the standard deviation. And in doing so, it tells us that the higher the number, the more steady the growth of their earnings, of their operating margins are over a period of time. If the lower the number, you can think of it as there would be volatility in their operating margins, highs and lows. We prefer to look for the companies that steadily grow over time because we're long-term buy and hold investors. And so we when you compare to the S&P 500, we do see value still in the small cap space.
Yeah, I'll just add too. I mean, as Brad's pointing out, like we are able to find opportunities, great quality companies in the small cap space, but just for small caps in general, If we do start to see rate cuts maybe later this year, as the market currently expects, I mean, this should bode well for just the small cap space in general as the cost of capital goes down. All right, so moving on here, and we're going to move on to some economic data and trends we are seeing, and we'll start here with the labor market. So overall, we do continue to see a very resilient labor market. However, we are starting to see some signs of normalization. For example, if we look at non-farm payrolls, which would be the blue bars here on this chart. So in 2022, payrolls actually grew by an average of 377,000 per month. However, last year we saw that number drop to just 255,000 jobs added per month. While this is still high, I would actually say impressive given kind of the rapid increase in interest rates we have seen. This is much closer to levels we were witnessing pre-pandemic, which was closer to around 185,000 jobs added per month. Another key trend is this continued return to the workforce. So the labor force participation rate among prime age workers. So this is going to be your workers between the ages of 25 and 54 years old, is currently at multi-decade highs. And this increase in the supply of workers is really helping slow wage growth, which is represented on this chart by the gold line here. And you can see that's gone from 6% at peak to around 4.5% today. So wage growth, it is still above the 3 to 3.5% level, which would likely be consistent with 2% inflation. We do feel the downward trend is very promising. And I did want to point out, because we got some interesting data just last month, we saw a slight uptick in wages as well as payrolls. As I mentioned, you can see on the right-hand side of the chart here. However, there does tend to be a lot of noise in the labor reports around the holiday season, and we feel a lot of this is going to be flushed out in the coming months. So just on the labor market overall, I think the best way to characterize it is it's still tight, but at this point, we feel it should not pose a further inflation problem like it has in years past. All right, so moving on to inflation here. So essentially for the last 2 years, all eyes have been on the Fed and basically questioning whether or not they will be able to so-called thread the needle, which is basically just get inflation under control without pushing the economy into a recession. Well, I'd say so far, this soft landing or no landing, whatever you want to call it, that type of narrative is still very much in play, as they have been successful in reducing inflation. And meanwhile, we've continued to see strong GDP growth. If we just look last quarter, 4Q23, we saw GDP growth of 3.3%. And current estimates for first quarter 24, we're seeing are close to 2.93%. So kind of just jumping into the charts here and what we're seeing. We'll start with the consumer price index chart on the left here. So you can see the headline consumer price index. This is the gold line. So that peaked in mid 2022 at 9%, but has since fallen to just 3.1%. If we look at the core reading, which would be the blue line on the left chart here, so this strips out volatile items like food and energy prices, but you can see it's also trended down from peak, and it's currently at 3.9%. So every time we look at the CPI prints, one of the more interesting things that we continue to kind of recognize is the large weighting to shelter costs, which do continue to be a headwind. So shelter, I think they represent, it's just over 30% weighting in the headline CPI number, and it's 42% weighting in core. And again, this is important to consider because shelter, which tends to be a very lagging indicator, and this is pretty much just due to the typical one-year rent agreements we see, it's still running at over 6%. However, when we look at some of the more live rent data from places like Apartment List or Zillow, we've actually seen rent prices started to go down year over year. And that's basically been a trend for the last, I think it's around 6 to 7 months. So we feel as this data starts to flow into the CPI report, we will likely continue to see CPI trend down. And here, looking at the other inflation gauge, or the personal consumption expenditure index, it's the chart on the right here. So the PCE, it does differ slightly from CPI in the calculation. For example, housing costs only represent around 15 to 20% of the index. And then unlike CPI, which uses a fixed basket of goods, the PCE weightings continually change, and this is going to be based on consumer spending habits. However, much like the CPI, you can see here the trend has been lower. And the most recent core PCE reading, which is the blue line on the chart on the right here. So this is the Fed's preferred gauge of inflation in the economy. And you can see that the latest reading was actually just 2.9%. And just a note, we actually do get new PCE data tomorrow, so we'll be watching that closely. I believe the expectation currently is for it to come down slightly to 2.8%. So just to kind of wrap up on inflation here. So while all the inflation metrics we are looking at are still above the 2% target levels, I would say overall the data continues to be encouraging. And assuming this trend holds, it should give the Fed a green light to start cutting rates later this year. I think now Brad's going to walk us through some data on the consumer.
Yeah, and to touch on Christian's inflation charts, for those of you who've been to the store or the grocery store recently, it might not feel that way. Inflation still feels pretty heavy when you go to the store, but the good news is that inflation is trending down. So hopefully we see more normalization soon. But to touch on the consumer in our eyes, and much like Chris was talking about in the labor market and inflation, we are starting to see more normalization from the consumer. And so here are a few data points that we look at, but not all the data points we look at yet again. But if you look at the top left chart, the household debt service ratio, these are debt payments as a percentage of disposable income. So your gross income minus taxes, disposable. A large percentage of this chart is mortgage debt. And the good news is that what we're seeing is that 60% of mortgage holders now have a rate of 4% or below, and 83% of overall mortgage holders now have a rate of 5% or below. So you can see here that pre-pandemic, it kind of flatlined. That makes sense. Interest rates were very low, near zero. It dipped during the pandemic because there was, pause on payments for debt and things like that. But it ticked back up after payments kicked back in. But you can see it's still below the previous trend, which is promising for us. And it shows that there is normalization when it comes to debt service, but it's also a tailwind for clients if you have extra disposable income to pay for other things. The next chart on the top right is the personal savings rate. Again, you could see during the pandemic, it spiked dramatically. That makes sense. Everybody got stimulus payments. That money went into the bank because they couldn't spend it during the pandemic. And the fact that it came trending down fairly quickly is not surprising for us. There was a lot of pent-up demand. People tapped into those resources that they had for savings. Even though it is below trend since around 2009, it's still not as bothersome to us because we expected it to come down pretty heavy because people are happy to spend right now. We expect that line to normalize and kind of stay as historical norms as we go forward, but we keep an eye on that as one. The bottom left corner, the retail sales, for those of you that joined our last webinar in August, we talked quite a bit about this. You can see kind of in the middle of the chart when the pandemic hit, obviously retail sales slowed dramatically. People were locked in their house. You couldn't go out and spend any money even if you wanted to. Well, then you can see as the gold line spike along with the growth being the blue line, people took all that excess capital once they were allowed to go out and buy, and they pulled a lot of demand forward. People were tired of looking at their same TV, their same couch, and they used that extra capital to go buy all sorts of new things. Well, it's not surprising to us that the retail sales is kind of flattened there towards the end of the chart, and also that the growth has fallen. Because if you recall from our last webinar, we talked about people transitioned from buying TVs to going on trips and going out to dinner more and things of that nature. So this, in our eyes, is only normalization when it comes to retail sales. There was, a traumatic event that happened, and we're getting kind of back on track, even though it's been years since. If you now look at the bottom right chart, the discrepancies, these are 30-day plus delinquencies, excuse me. Most of you, if you watch the news or read articles in the paper, a lot of what the news does is they focus on just the very tail end of this chart. And the gold line and the green line are autos and credit cards. Obviously, delinquencies have ticked up, but when you focus on a lot what the news is telling you, they show it in a very short time frame as a straight up line. That freaks people out. Delinquencies have ticked up. oh my goodness, it's scary when it's a straight line. But if you put it in the context of historical, from an auto standpoint, a credit card standpoint, we are slightly above where we were pre-pandemic. Now, I get it's trending up. Well, it makes sense. Interest rates were near zero. Then they spiked up. Auto loans have become more expensive. Credit cards have become more expensive. And there is a stat that says we now have more $1,000 car payments than we've ever had in the United States. So people went out and splurged and bought a nicer car. Not surprising, this line has ticked up, but we expect it to kind of normalize and flatten out as we go forward. The last line there, the dark one at the bottom, is the mortgage. And if you look at what I talked about in the top left chart, people now have cheaper mortgages than they've ever had, and more than 80% of people are locked into those mortgages. So it's not surprising we saw a dip after the pandemic due to a pause on mortgages and things of that nature, but it's still not above past trend line. So we find that as a good sign. And overall, if the Fed continues to talk about cutting, and they do cut multiple times this year, that should help these to flatten out over time and things would become more affordable. So overall, I think normalization is the story behind the consumer right now.
All right, moving on here. So to wrap up, we have been getting a lot of client questions concerning some geopolitical risks. And regrettably, we have seen many examples of these type of risks just over the past few years. Obviously, the Russia-Ukraine war, the current conflict in Israel, and the ongoing tensions we see in the Middle East. And there's also the looming threat of a Chinese invasion of Taiwan. So to help shape our view on geopolitical risks on the markets, we wanted to present some data on the market response following these types of situations. So looking at the table here, we show 39 examples, which go back as far as World War II, of some of these geopolitical events, and then the S&P 500 return following these events. So just to point out, we obviously couldn't include every event back to 1940. Being that we only have so much room on the slide. However, we do feel like this should be a good representation of the market's reaction following these types of situations. So I would say what stands out the most from this table is just the heightened volatility we do tend to see directly after these events. So you can see here, if you look at the 1 month S&P 500 return column, you can see that the median return was actually negative 1%. However, over time, and as we see some of this initial uncertainty subside, the market does tend to rebound from these challenging times. If we look at the median return 12 months after the event, it was actually 7.4%. And looking as far out as 3 years, which is the far right column here, the median return jumps to over 20%. So just to kind of summarize here, we do tend to see a lot of volatility. We expect volatility directly after a lot of these type of geopolitical events. However, you can see that the stock market does show a lot of capacity to rebound from the uncertainty, and it does boast a great track record of resilience, which is why we advise clients to stay invested during these challenging times.
And I'll touch on a typically a very sensitive topic for anybody. But to Christian's point about market events, we obviously have a large market event happening in November of this year. We have the presidential election. To be honest, the market hates uncertainty, and we expect volatility in November. And to be honest, the president has less control over the markets than most people assume. To a very large degree, the markets are going to do what they're going to do. And we are more concerned about kind of fundamentals than who is president. And so saying all that, and to Christian's point on what happens after periods of times after market volatility, when you look at this chart here, this goes back to 1953, and it's every president since then in their term. And you can see the market goes up. It doesn't matter who's president during most of these periods. Nixon, you can see, had a slight dip towards the end when he left office. And then George W. Bush, obviously, there was a few things that happened. We had 9/11, unfortunately, and then the global financial crisis happened right on the end. But you could still see that the market was still trending up during his presidency. So I guess overall, this will not change our approach or allocation. as clients who have been with us know, we plan to be invested throughout this volatility, and we plan to maintain our disciplined approach of long-term investing. But regardless of who becomes president, this isn't even the biggest problem that we're going to run into in the near future. Our government debt, in our eyes, seems to be a bigger issue.
Yeah, and to Brad's point, so the federal debt is actually it's gone up dramatically, not just from COVID, but actually since started around the global financial crisis. If we actually just look back to 2007, the US debt to GDP ratio is just 35%, and today it's around 95. This is a level we have not seen since World War II. And we do feel that it was necessary for the federal spending during COVID to, avoid depression-like scenarios. However, the key theme now has to be to get federal spending under control. And that's especially true given this higher interest rate environment that we are in. So kind of looking at the charts here, we have the US Treasury debt by year of maturity. And you can see that around 50% of the debt is set to mature over the next 4 years. And this is going to have to be refinanced at much higher rates, which is going to drive up the interest expense. This, along with the continued budget deficits in the neighborhood, the estimates around 5 to 6% of GDP, is only going to exacerbate the problem. So if we look at the chart on the right here, this is actually the most recent Congressional Budget Office projection. You can see that interest expense is actually going to get over $850 billion this year, which will actually pass the total defense budget. And it's expected to reach $1 trillion by 2026. So this is obviously a problem, being that the cost to service the debt is going to start eating into maybe some more productive spending or investments. So it could actually slow future GDP growth. We do feel we are in the early innings of this problem, but we also do feel there will need to be some politically difficult decisions, whether it's curb spending, raise taxes, or both, over the next few years.
And to touch on a little, we will be touching on this much further at our annual economic forum in May. So expect the invitations to come out around in April at some point in time. But that is going to be the main focus of our economic forum. That is in person, and we also do a webinar tied to it. So feel free to come out and join us and get some in-depth on the government debt. But to finish up, next, click over, if you will, Christian. So that concludes our portion of it. I know it was a lot of information in a short period. If you have more questions, or if you want more in-depth data, please reach out to us. Our contact information is on the screen, but we'll go ahead and look at questions that came across. I'm only currently seeing one. If you have questions, feel free. It's a good time to do it. If not, reach out to us. But the question I'm seeing is, we touched on the equity portfolios and the equity markets, but what are we doing with our fixed income portfolios? Christian, I can take that one if you'd like.
Yeah.
Our fixed income portfolios are more for capital preservation. We take the risk on the equity side, but we feel like our valuation matrix, our risk-adjusted returns will look better over time. But from the fixed income standpoint, we stick to kind of short duration laddered bond portfolios, and we pair that with the money market fund. So currently, we're only going out about 1 to 3 years on treasuries. We have been looking at other fixed income asset classes for higher yield, but to be honest with you, we haven't been finding a lot of spread from where we are in treasuries right now. And since the Fed has kept short-term rates high for the time being, we're kind of sticking in that 1 to 3 year ladder and pairing it with the money market. So I hope nothing extravagant or crazy when it comes to fixed income typically here. So let me see. I don't see. Oh, hold on. We did get another question. Let me see. Okay, good question. Might AI be a bubble in the making? A few firms actually benefit, but all boats seem to be rising, maybe unrelated. Chris, you want me to take it, or you want it?
What was the actual question? Is it
May the AI, do we maybe have an AI bubble in the making? So I'll touch on it. There was a So NVIDIA is kind of the center, in my opinion, of the AI universe right now. Last Thursday, when they reported earnings, they added 288 billion to their market cap in one day. That's amazing to me that they could grow that much in one day. It took 24 years for NVIDIA to reach a $1 trillion market cap, and it only took 8 months for them to reach the second trillion in market cap, and 266 billion of that came last Thursday. So with that being said, it looks like they are kind of the sun in that all other AI firms are orbiting around right now. And they came out with the 13F, and it showed that they actually had bought into a lot of other AI firms themselves. And it's rare that a company would issue kind of a 13F that tells of their holdings, but it shows that NVIDIA believes that this AI future is promising. For us, a lot of those names are unprofitable, the ones that they invested in. And NVIDIA themselves, as they're growing so dramatically, that's our fear, is that there could be an AI bubble forming. But the problem is a lot of the names that we're currently buying that we talked about, Microsoft, Apple, those names, they're still trading at very reasonable valuations. And Christian, I can't recall if you do, what is their growth compared to NVIDIA? NVIDIA is 110 for forward. What were you finding?
It's closer to 15% on average for those other companies. Yeah.
Yeah. So the other companies that are kind of in this magnificent seven, they're still growing at reasonable rates. Given 110 is amazing, but we still see that those companies are fairly valued compared to the NVIDIAs and the other AI businesses. And I do understand that there could be this bubble forming, but we're not partaking in that particular side of it because we do look for companies that have positive earnings and things of that nature. So yes and no. I'm hoping it's not a bubble, but there is potential for one rising. It looks like we got another one.
Looks like I can see them now.
Okay, there you go. How much of the global? Okay, so how much of a threat currently are global events, China, economic slowdown, Russia, Ukraine, etc., to the U.S. markets? Do you want it or you want me to take it?
I mean, I mean, we obviously presented the data on kind of the
Yes.
short-term volatility that we do typically see. But over time, the market tends to react. As far as China, like China's economy, I know has been kind of slowing for probably the past year or so. And we've seen, I mean, we saw 4.9% GDP growth in the US in 3Q, and then we were at 3.3%. So as far as the US, the economies are intertwined. But the US kind of leads the way there. And we do, as Brad's kind of saying, we are a consumer-based economy. It drives around 70% of GDP, and consumers still look very, for the most part, I would say, they normalization, but they still look very healthy.
Yeah, and I would also add to that I think China's a big story that people aren't so much talking about. I mean, it's the second largest economy in the world, and most of their real estate companies in their index or their market are bankrupt or in default. And so I do think there's a bigger story there, but we are less affected by the real estate side of China. And like Christian said, we're more of a consumer-based economy. So there is threat for economic slowdown, but even when Russia invaded Ukraine, obviously there was volatility in the short term, but quickly after that, I think, supply chains changed. Anything that was being made in Ukraine was moved to India or Africa or back to the United States or South America. So the market adapts. And to Christian's point, short-term volatility, usually once it settles in over time, people start to realize the issues aren't as big, or there are workarounds for those issues. So we're not as concerned, although we do avoid China as an investment, or we attempt to avoid China. Sometimes it's intermingled. Article on passive investing that, okay, you can. Yeah, so the question is, can we comment on our approach to active investing and not falling into the passive investing trap? So you want me to take it or you want? Yeah, you want me to take it? So
Yeah.
basically, I agree. Active management, so like active mutual fund management compared to passive. Passive has become kind of the belle of the ball. Fees are, it's a race to the bottom on fees, and we understand that. We actually participate in passive management. The way I like to describe it is each one of our asset classes, say large cap growth as an allocation. Currently, we're allocating about 25% to our large cap growth portfolios. We put an indexed ETF in there to get kind of a broad exposure to the market, but it's usually not a very large percentage of the overall large cap growth allocation. And then we build our individual stocks around it to kind of help get that risk adjusted return and hopefully reduce risk. So for us, passive investing is just capturing the overall market, and that large cap growth ETF that we're adding, it is a passive investment, but it also has the Nvidias, because we don't want to completely miss out if there's a run up, but it's a very small portion of the overall portfolio. Active investing, typically over time for us, the fees erode away when you're talking about mutual funds, and all most do is try to match the benchmark or meet the benchmark. And in doing so, you kind of erode your own performance over time when you get into active mutual fund management. For us, trading is free anymore, and there's no expense to buy individual stocks. So when it comes to active management for us, putting that passive anchor in with active management around it makes sense to us, because we're not paying that extra fee kind of on a mutual fund or an actively managed portfolio. I hope that answers the question.
I'll just add, because I think you mentioned it early on the webinar here, is just as far as when you look at like the Russell 2000, which 44% I think are actually not generating any earnings right now. So that's part of the, when the risk you can take on sometimes when you look at some of these passive investing vehicles. And our strategy of kind of looking under the hood and looking at actual companies that are actually generating profits and also, have very reasonable valuations, we feel like that is actually a better strategy than kind of just following this passive investing strategy.
Yeah. We have another one. It says, do we need to worry about bank failures like Silicon Valley Bank? You want it, or you want me to take it? Yes and no, I guess would be the answer. I would say not as much. I think Silicon Valley Bank had a specific clientele. And, the banks that did fail during Signature Bank, Silicon Valley Bank, their, I guess, banking customer wasn't like the normal regional bank that we're seeing. Silicon Valley Bank had a lot of tech people, a lot of large deposits because of those people. They had a lot of ties to crypto, things of that nature. And so when that set of the market fell out, and a lot of those, it was a run on the bank, basically. Those tech people saw what was coming. They started to pull their assets, and it was a quick fall for Silicon Valley Bank. The same goes for Signature Bank when it failed. So in our eyes, not every bank is created equal. And on our last webinar last August, we talked a lot about the commercial bank exposure, because regional banks typically have higher commercial loan exposure. And obviously, if you live in Denver, you can see most of these buildings are half full, and even our building that we're in is only about 40% full, although we're in the office most of the time. Banks, that was the fear back in August. That was continually the fear. And some people might say that should we still worry about it? Well, the ones we're buying, the banks we're buying, we look at that kind of exposure on their balance sheet, and we try to limit the risks from that standpoint. The overall regional bank, it has gotten, I guess, more solidified than it was. I know the indexes were down and it was hurting, but we still find pockets of value when it comes to those banks. And we don't think that there's going to be any banking issues, as long as the Fed as inflation comes down and the Fed starts to cut interest rates and things normalize. And I mean, the consumer, as we talked about, is healthy, and we feel like there's a lot of normalization that is happening, and it's tough to say, but the regional banks, I think they're going to be fine. You got anything to add?
I mean, I would agree. I think the more worry that we see on the specifically on the regional bank side is the exposure to commercial real estate. I think we actually touched a lot on that in the August webinar. But as far as looking at the actual commercial real estate and specifically to some of maybe these C-grade office buildings, that's probably the biggest risk to a lot of the as far as write-offs looking forward and the write-offs that we may see from the regional bank side. But as far as another situation like Silicon Valley Bank, that seems like a very much a one-off, and as Brad mentioned, more of a run on the bank with kind of everything aligning.
Yeah. We have one more in here. I will make it. It's 12:45, so we can close with this one. It's a little political, which most people try to avoid. So, let me see if I can summarize. In times of both domestic and international political uncertainty and looming potential conflict, how much attention, if at all, is paid to U.S. Politicians' stock buy, shorts, etc., given they may sit on various boards and dictate literal policy decisions that affect publicly traded companies? You or me? You wanted to?
I mean, I could probably answer it pretty short. Like, we do not pay attention to that.
Yeah.
Again, I think we've talked about, but I mean, we're more concerned about actual company fundamentals and valuations and profit stability scores rather than actually, what politician may or may not be buying the public company stock.
And I also think that the way we allocate is we don't overexpose to any one asset class or one sector. We try to weight evenly. And so for us, the exposure, even if it's one name that's brought up in the news because a politician bought it, doesn't typically affect the way we think or change our allocation because we're kind of equally weighted and sector allocated across many different sectors. So it might not fully answer the question. We might have skirted it a little bit, but but we don't. I mean, in the end, we don't really pay that much attention to it. But we will. Well, we got a couple more. Let me see if they're read. Oh, I think we're out of time. Really appreciate everybody's time. Again, our contact information is on here. Christian and I enjoy these conversations. If you want to reach out one-on-one, feel free. Give us a call anytime. We really appreciate everybody joining. We hope to have more of these in the future, and have a great rest of your day.
Thank you.